Hello everybody, it's Julianne me, and just a comment in relation to the Zoom. This Zoom number will be the same number that we'll have for this week and next week for our 2 tutorials and our lecture. For some reason we couldn't actually give co-hosting if you wasn't logged in, so it was easier just to set up another one. And you're in week 7, you'll revert back to the original Zoom number. So just FYI. So this afternoon, what we're talking about is the audit overview, or an overview of the audit process. So I'll just share my screen because I've got some slides that you has kindly put together. And I just need to get up my chat so that I can, if any of you put anything in the chat, I can have a look. So what I will turn off my video because I think that works better in the recording. So I just will do that when I just, here it is. Okay. And my participants. Okay, so yeah, so my recording is not. Oh, sorry, the recording from last week I think worked fine. I put it up in a couple of, well, the tutorial was okay. I don't think anybody had any issues with that, or we haven't heard anything. If you are having any problems, please send through information to Yu, and she will either pass it on to me and we'll sort it out, or she will answer any of your questions. So let's just recap on what we did last week. And last week, this week, and are both fairly heavy in content, but they're trying to give you an overview of what's happening. So there's a lot of responsibilities, there's a lot of things that auditors need to remember. They need to remember that they've got to have judgment, they've got to have skepticism, so not believe everything that they're told. They've got to look at classes of transactions, and they've also got to look at account balances. They've got to make sure that their evidence is sufficient and appropriate. It also has to be reliable and relevant. So coming in, thinking about the conceptual framework from the accounting standards. In getting sufficient and appropriate evidence, whether or not that is the underlying accounting data, or whether or not you're corroborating information from a third party like a bank or a solicitor. In doing your financial, or asserting your financial statements, one of the things that you also do is we need to then have a number of procedures that go around. We need to consider our risk, we need to consider materiality, and there are a number of different types of audits that we actually can do. All of those are the process, if you like, before you actually get to signing off the accounts. Now, as you can see in this overview slide, those things, the responsibility of management is to prepare, and they use the same data. So, oh, my battery is running low, so luckily I have my if I can fix that problem. I didn't realise that that was the case. So, okay, so, okay, so it's important for us to as auditors to be in the right frame and consider all of the aspects. So in doing that, the main chapter in relation to this is chapter 4 of the book, and obviously many of the lecture slides pull together the information. Now, there's some homework, the tutorial questions, and some additional questions. Now, the additional questions we're not going to cover in class, in tutorials, but if you do have any attempt at those questions, please send them through to Yu and she'll give you some feedback on those, okay? And remember also that there's the continuous case study on page 183. There's an easy part and a more difficult part of that. So it's a case study that goes across a number of chapters as well. The quiz that she set up, I'm not going to go through those questions, but the answers are there. It's not a very well constructed, although if you guessed C to most of them, you would have got a lot right. So it's not necessarily a well constructed example, but an example nevertheless. And so you can go through that with those solutions. Now, I'll just give you a little bit of time to write those down. If you have actually had a go. Has anyone actually had a go at these quizzes? It's to help you with some general understanding. No, yes, no, maybe.
Yeah.
Yeah. So, as I said, I'm not going to go through them because it takes a little bit of time, and we've got a few questions that it would be better if we could actually get through those today. Okay, so certainly if you've got any questions, I'm happy to refer to any of them, particularly with the answers there. But if you've got similar, the same answer, great. If you understand why the answer is different, that's also good. Okay, so any questions on the quiz at this stage? No? Okay, so there's 5. So the first question then is question 17. Which talks about the 5 misstatements, and what's required is for you then to list the misstatement for each of those 5. Okay, so the first one is related to some inventory items are out on consignment to customers and were not counted during the physical inventory. So if that's the case, what we're talking about there is the actual management assertions of completeness, accuracy, valuation and allocation, rights and obligations and existence. Now these are outlined on, oh, did have the page, and now on page, here we go, on page 141. So there's basically two categories of assertions. There's the assertions about classes of transactions and events, and then there's assertions about account balances. So if we're talking about the inventory items being on consignment and not counted, what we're talking about there is the completeness, because we're talking about whether or not it's recorded correctly, which is on page 141, 1B. It's about the accuracy, valuation and allocation, because inventory is actually an asset. The rights and obligations, that's the right to an asset or the liability, the obligation to the liability. And that is, if it's on consignment, you have no rights associated with that. So it should not be counted, and whether or not it exists. So whether the asset, liability or equity interest actually exists. Okay. The next one is about during the physical stock take, the client's employees mistakenly counted some items twice. So if they counted them twice, that means the existence is not completed or is not fulfilled. The asset doesn't exist. It only exists once. Completeness, it's not what should have been recorded has not been recorded. Accuracy, valuation and allocation, it's the wrong value. Rights and obligations, you're only allowed to have it once. And then classification, it's not correctly recorded in the accounts. Okay, so the next one, basis of inventory valuation not included in the financial report. What did anybody have for this one? So these are the assertions on page 141, primarily number 2. Anybody? No? Okay. So really what we're talking about here is the basis of valuation. So again, it's existence, completion. So all of those 5 all link into the basis of valuation. Okay. Next one. Some inventory items are listed at cost when they actually should be listed at net realisable value, because net realisable value is lower. And remember from AASB 102, it actually requires it to be lower of cost or net realisable value. So what the point here is that all of these have more than one assertion when you gather your audit evidence or you use your audit evidence in your audit procedure. So the audit procedure might be to test the price, or to test the value of the inventory items. And if some are at cost rather than net realisable value, you're actually carrying out, or across all 5 of those assertions, to validate and therefore gather sufficient evidence that the figure that's in your accounts is true and fair. Because that's what you're saying at the end. And the last one is that the inventory counts of some of the items that are held are on consignment from the suppliers. Okay. And again, all 5. So the only thing that you're not testing when you find these issues, the only assertion that you consider, that you're not considering, is presentation. Okay, so all 5 of those can be included. Okay. The one you're probably testing the most in that case would be your rights and obligations. You could also say classification. I mean, you can argue for all of these, and that's why this question's classified as an easy question. Okay, so anyone got any questions in relation to 4.17? No? Okay. You can summarise the ones that, what happens against each one in relation to that. This one does have some presentation in it, the value. So what this little slide's doing is pulling all those 5 together and suggesting to you the assertion that you would most likely be considering. Now, I could argue, or I would argue, that valuation, the basis of valuation, actually is not only completeness, but it's also accuracy, valuation, and allocation. So the thing to think of here is sometimes auditors will differ in their opinion associated with this as well. Okay, so this is a little summary of one interpretation associated. If you had it slightly differently, then that's also okay. Okay, so long as you can justify it. Okay. Question 19. Now this is a little bit more difficult to think about, but here we're talking about risk and what's high in audit risk. So you're the auditor of PPL and you've got to identify and explain the accounts and the assertions that you think would be high risk. Okay, so in doing this, I think there's a spelling. Oh no. In doing this, you've got some different information in here. Now, this sort of scenario is not, well, it's not unlike an exam type question. The difference is that it will depend, well, certainly anything in relation to risk and what you might be, what assertions you might do and what the tests you might do maybe in an exam. Okay. So let's have a bit of a look. So and I'll just get my question so that I can. So the first thing is that you've got some invoicing processes, you've got some a new billing system, and you've also got some and it's something to do with inventory, and you've got some short shelf life in relation to your dog food lines. And the first thing is that Ashley has mentioned to you that sometimes it's difficult to distinguish between capital improvements and maintenance expenditure. Okay, so if you think about your accounts receivable, what you're looking at there is in sales, if you go back to page 141, what you're looking at there is your accuracy. So it says that some of the sales are not, you're actually not having correct billing. So if there's not correct billing, it means that your revenue accounts or your sales are not necessarily accurate. Also, if your sales are not accurate, your invoicing process is not accurate, then your accounts receivable may not be accurate, may not reflect the proper value or be allocated the correct amount that you are due to receive. So what we're talking about there is the accounts receivable would not necessarily be recorded correctly. The second thing that is identified here is the inventory. So inventory turnover slowed dramatically, and there's this issue about the short shelf life. Now, if there's an issue of short shelf life, that means that you might have obsolete inventory, so that the figure that's in your accounts would possibly not reflect the lower of cost or net realisable value. And if your lower of cost or net realisable value doesn't work, then that means that your valuation in your balance sheet or the value you have in your balance sheet of that account may not be correctly stated. It may not be accurate, and the allocation may be incorrect as well. And then the third thing is the capital improvements to the maintenance expenditure. So if it's capital improvements, that means it's a balance sheet item. If it's maintenance expenditure, it means it's a P&L item. So is it classified correctly as a transaction or event that sits in your P&L versus an asset that sits in your balance sheet? Is the figure accurate? Is the valuation accurate? Is it measured correctly? Is it measured appropriately? So one way some companies reduce their maintenance bill is by capitalising their PP&E cost and then depreciating it at a lower value. So they write it off over. So if it's a PP&E item that's a 10-year item, it's written off at 10% per annum. But if there's a large maintenance expense, for example, on the air conditioner, and if it's an overhaul of the air conditioner, then or a replacement of the if it's a replacement of the air conditioner, it would be capitalised. However, if it's an overhaul a major service to the air conditioner, that's a maintenance expense. But both could be large values. And one way to improve your profit is to take the large value expenses and capitalise those. So that's something that auditors need to be aware of to make sure that what should be in the fixed assets is in fixed assets and what should be expensed is expensed. Now, it could be another example of an expense that is sometimes incorrectly capitalised is legal expenses related to property. In your purchase, your stamp duty and all of those expenses are part of the value and classification of the fixed asset. But toward if you have a dispute, such as a rent dispute or like a tenant type dispute, or you have a neighbour dispute in relation to your property and you require legal assistance, that expense is not a capital expense for your legal fees. So there's some fine line for auditors to consider that what has gone into accounts. Okay, any questions in relation to that one? No? Okay. Did anyone have any other accounts? I think that's all we've got, those ones. Yeah. Did anyone have any other accounts in relation to that? Or any other assertions? No? Okay. All right, now 24 is the next one. And let me just turn over the page. 24 has got 5 questions for you to think about as the auditor. So basically what we want you to do is for each of the scenarios, see whether you think for each individual one, whether or not there is sufficient appropriate audit evidence. So what we've tried to do in this one is give you a little bit of a taste across each of the topics that we covered last week. So the first one is you're the audit senior. Gillian attended the stock take and observed that the client followed the stock take instructions. Gillian selected numerous items for testing from the client's inventory, and they were all found to be correct. Cut-off details were noted and subsequently checked and treated correctly, and she concluded that the information was then stated fairly. So the question is sufficient audit evidence. Is there sufficient audit evidence in that case? Now, she hasn't actually verified all the material assertions. So she has looked at completeness, she has looked at existence, she has looked at cutoff, but she also should check for completeness and value and allocation. So there doesn't seem to be any tests in those inventory sheet information to find out whether or not the correct value, that is lower of cost or net realisable value, is actually tested here. Okay. The next one is that she's selected 20 invoices to test the control that the sales clerk checks the prices. She found 3 instances where there wasn't ticked, and they said that sometimes they forget to sign the box. And the prices all agreed, and she concluded that the control was satisfactory. Now, again, this control tested the effectiveness, but it was 3 out of 20. And just because the price was correct didn't mean that it was actually because it existed. Okay, so what she should have done is extend her test for, say, another 20, and if there was still another 3 out of the 20, then she might have been able to get away with that. But if she then tested and there was, if she tested that there was no more, she might have been able to get away with it. But because there were 3, it means that the existence assertion is not sufficiently supported. So you have to do more testing to actually make sure it is sufficiently supported. And it might be that it was only those 3, and you might test another 400, or in a different, you might either do it continuing the test that's happening in that month, or you might go to another month and have a look at what happened later in the year or earlier in the year to see whether or not there is an existence assertion. Okay, so the third one is the subsequent events. Now, do you remember what subsequent events are from your, those of you who are doing AYN 418 probably won't know this yet, but you would have done it a little bit in, I think it's in 417. Is that one with Belinda, where you look at the financial accounting? Is that? Not sure whether it's, yes, okay. So in financial accounting, you will have looked at subsequent events in your accounts. And what we're talking about there is something that happens after the period end. So usually the period end is 30th of June if you're doing a financial year, and but information happens after that event and before the audit is signed off. That's a subsequent event. Now, you might have a subsequent event that happens after that date as well, and they are treated slightly differently. But before you actually sign off the accounts, one of the things that the auditor needs to do is have a look at what has happened, particularly in relation to cut-off after the 30th of June, in the first couple of weeks after the 30th of June. So is something in the prior year reversed in the beginning of the new year? Okay, so in this case, a large number of returns have happened. So, and it's the 20th of August, so these happened on the 1st of July. So again, not enough supported evidence. If they're returned, what does that mean? That means that you have inventory will go up. It also means that your accounts receivable will probably be reversed and therefore reduce. Your revenue would then be in the new year in the negative. So you're starting off in a negative position because you've got returned inventory, you've got less accounts receivable or collectible cash, and you've got, so your sales will have gone down as well. And the other thing to remember is if you have sales returns, it's usually about a product that will have a warranty. Now there's a whole provision, there's a whole standard on the provision of warranties, and that standard requires you to have sufficient information in your provision, in your liabilities in relation to warranties that you need. And usually warranties is one of those calculations that the management will come up with a series of formula and on the number of returns that they're expecting. And one of the things that the auditor needs to do is value that for reasonableness or review that for reasonableness. Now, sometimes that will require a third party to come and help you do that. So someone else from your office, or someone else from another firm who specialises in that work. So the position that you're in at the end of the year is reflected particularly. So if your provision for warranty was very low and you had all these sales returns, there could be a possibility of fraud happening there. Okay, so or earnings management, where the staff are increasing the sales so that they get bonuses. Okay, so there's sometimes a trade-off. That's a good place to look for. Provisions and returns are a good place for auditors to look to make sure that there's no possibility of fraudulent activity. Okay, so number D is about advertising expenses. It's only 50% of what it was last year. So just because it was just because it was 50% of last year isn't a reason to say that that's correct. It could be that those advertising expenses are understated and miscoded into or misclassified into another account, possibly not on the P&L, but on the balance sheet, and they've been incorrectly. They may have been incorrectly capitalised. Or they may be in, they'll be perhaps being capitalised into a prepayment or into an asset of some description, and they are also in your accounts receivable. So that means, in your accounts payable. So that means that possibly your advertising is understated and your balance sheet has overstatements in it. The only reason that advertising would be cut by 50% is if there was an appropriate action by the company to make that decision. So and that would be a minute in a board paper, which so you look at board minutes to have a look at that. So what you've got to try and do is validate why it's so much lower. You'd have a look at the budget and see why it was so much lower. You'd have a look at any of the commentary in your client meeting notes that you would have in relation to why something is so much lower. Now, the sorts of things that you would expect to be lower would be from one year to the next. You might have, if you had an IPO, a float of an organisation, you would expect legal fees to be related to the IPO to happen and in 1 year, and then that would be reduced or negligible in the following year, depending on the timing. If you had redundancies, you wouldn't expect to have high redundancies across every year, but you possibly could have redundancies in 1 year based on a restructure of an organisation. So it's about understatement of expenses is what you need to consider. Okay, DE. Now, this is about accounts payable, and there was a 15% error on her 3 items that she didn't that had no services provided in June. Sorry, that did have services provided in June, and they weren't accrued. Individually, they may have not been material, but collectively, 3 items is out of 20 is not like 15% is too high. So you'd have to extend your test, and you'd have to see if the 15% could be reduced. And the other thing you'd have to do is you'd have to ensure that if your liabilities are not correct, then your profit is also not correct. All right, so you've got some issues associated with incorrect allocation of your service provision. Okay, I think that's all in relation to that one. So in this case, all 5 of the examples didn't have enough information. All 5 were valid tests, but they individually didn't satisfy completely. And so it's a matter of pulling together a number of tests that actually cover a number of assertions. Does that make sense? Yes, tick, or yes in the, excellent. All right, so the last one is about, given this information, suggest the benchmark, list some factors for preliminary materiality and describe when you might alter it. Okay, so I'll just go. So the factors, the issue is about whether it's a publicly listed company or not. And this is a publicly listed company. You're told that it is a publicly listed company, and therefore, if the information, such as the profit before tax, is unreliable, then there's a number of things that actually could be incorrect. So if it's a large publicly listed company, the general effect on materiality is that it would likely decrease the preliminary materiality. And that's because it's a publicly listed company, so lots of people actually have a look at the information. It's distributed far and wide, including to places like ASIC. So it'll be a quite complex annual financial report or annual statements, and there's lots of things that they've got to have actually got to comply, lots of requirements that they've got to comply with as publicly listed companies. So your shareholders, so in this case, the major shareholder controls the board. So that's also a decrease in your materiality, your preliminary materiality, because if they're a major shareholder and they can use their influence, they may want to have certain results occur. They manufacture and sell infrastructure to the construction industry. So there it's long-term, or their projects are long-term usually, and therefore they're probably of a higher risk, and so that would result in a decrease in their preliminary materiality level. Now, remember, preliminary materiality, and I think we're talking some more about materiality today, but the analysis of materiality, remember, it's an inverse relationship. So if the audit risk is lower, the materiality is higher. If the audit risk is higher, the materiality is lower. Okay, so that's on page 159 when you're talking about performance materiality and specific materiality, accounting materiality, and overall materiality. So, but remember that little diagram about the inverse and the audit risk of materiality. Okay. Okay, the economy is static. Again, probably will reduce your materiality because there's future pressure. And it says internal audit is effective, and they've had some reliable internal control. So again, so long as you've got a plan to test your controls, that would actually go some way to mitigating the negative impacts of your other audit risks. And then the last part of the question is they refinanced their debt, and their rate, and part of their requirement was that their ratio was to be better than 1.1 or 1 to 1 for their debt covenant. So their equity equity ratio, so the debt to equity ratio. So there is a forecast there that could be breaching their 1 to 1. And so if that was the case, they would need to be extremely, auditors would need to be extremely cognizant of that compliance of that debt covenant. And you'll often hear in some discussion about breaching debt covenants, but that's one of the reasons that organisations need to have that contractual commitment with their banker not to breach their debt covenant ratios. So ratios, I think we look a little bit at ratios tonight. If not this week, it's next week. It's in these next couple of weeks. Yeah. So I think that that's it as far, yes, and also I want to stop sharing. Right. So has anyone got any questions before because what I have to do is I have to stop the recording and go save it down and come back. Okay. So I will stop the record. So I will stop the recording.